We're jumping straight into SPDR Gold Trust today. Everyone's watching the price action, but the real story is the massive structural shift caused by central bank accumulation.
Exactly. You're tuned in to the Easy Money Show, where we make sense of the market's biggest moves. I'm glad you're with us.
And before we get to the gold bars, do us a quick favor. Make sure you're subscribed and go ahead and hit that like button. It really helps us get this information out there.
So let's set the stage here, because the numbers we are seeing on the screen right now are, well, they're frankly historic.
They really are.
We aren't just looking at a standard quarterly earnings beat or, a mild uptick.
No, this feels different. Usually when we talk about breakouts, we're looking at a chart that's poking its head above a recent high, maybe testing a level from last year. But right now
is different.
we are looking at what the pros call a blue sky breakout.
Which is a great term, but I think it gets thrown around a little too loosely sometimes. In this specific case, however, it's literally true. For those listening who might not stare at charts all day, a blue sky breakout means the price is trading at a level where there is absolutely no historical resistance overhead.
Right. Think about it like a rocket leaving the atmosphere.
Yeah.
Once you clear that last layer of gravity, or in this case, the last layer of sellers, there's no friction.
None.
There are no bag holders from 5 years ago waiting to sell just to break even. Everyone who owns it is in profit.
No clouds above, just blue sky.
And the numbers, they really back that up. We've got the underlying gold price trading right around, what, $4,830 an ounce?
It's around there, yeah. And the ETF itself, the SPDR Gold Trust, recently closed around $496, just hitting all-time highs.
It is. And while the price action is exciting, what's happening underneath is, I think, even more significant. We aren't just seeing some speculative frenzy like, the meme stocks a few years back.
Not at all.
We are seeing a fundamental reshaping of who owns gold and why.
And that distinction is vital. If this were just retail traders chasing a green candle, I'd be worried about a crash tomorrow. That kind of money is fickle.
It moves fast. But this isn't just retail.
No, this is the whale argument. And honestly, it's probably the single most powerful driver in the bull case right now.
We need to drill down into this data point you brought up. Central banks are purchasing roughly 585 tons of gold per quarter.
585 tons. I mean, just try to visualize that. That is a staggering amount of metal being taken off the market.
And locked into sovereign vaults.
Exactly. That's not for jewelry. It's not for industrial use. That is strategic accumulation.
But here is the key insight, and I think this is the real aha moment. If you take one thing away from the bull case, let it be this. These buyers, the central banks, they're what we call price insensitive.
That changes the entire game. Think about how you or I trade. If a stock I like spikes 10%, I might wait. I want a deal. I'll try to buy the dip.
Sure, you're looking for an entry.
Right. A hedge fund is the same. They care about their quarterly P&L. But central banks,
They don't care.
not about the price. They aren't buying gold to flip it for a profit next month. They're buying it to de-dollarize their reserves for strategic safety.
They're buying insurance.
They're buying insurance. And when you buy insurance for your nation's economy, you don't haggle over the premium, you just pay it.
Because the alternative, being exposed to a currency you're trying to diversify away from, that's the bigger risk to them. So what does this massive price-insensitive buying do to the ETF's price?
It creates a floor. We call it the central bank put. In previous cycles, if gold tanked 10%, you had to wait for nervous investors to step back in.
The price could just free fall.
It could until value investors showed up. Now, you have a guaranteed buyer of last resort who is scooping up supply, really, regardless of the price. That creates a structural support level that just didn't exist 10 or 20 years ago.
It's like having a safety net made of solid gold bars. That brings us to market sentiment, because it feels like everyone is on board with this secular bull market idea now.
The consensus is incredibly strong, almost suspiciously strong, which, we can get to later. But we're seeing analyst targets that would have sounded crazy just a few years ago.
Yeah, let's look at some of these numbers. And again, this isn't investment advice. We're just reporting what the big banks are putting out there.
Yeah.
We've got Goldman Sachs seeing potential for gold to hit, what, 5,000 to 5,200 an ounce by late 2026.
Which is a significant move from here. But then you have Deutsche Bank. They're even more aggressive. They're talking about a potential path to $6,000.
$6,000. So if we translate that to the ETF price,
Yeah.
What does that even mean?
Well, a move to 6,000 in the underlying metal implies the SPDR Gold Trust could move well over $500 per share.
So we're talking another 20 to 30% upside from these current all-time highs.
From all-time highs, yes.
That is wild. An asset that's already at an all-time high having another 30% to run. That usually doesn't happen unless the macro backdrop is, well, perfect.
And that's the thing. The macro backdrop is nearly perfect. We call it the perfect recipe. It's rare to see the stars align like this.
Break down the ingredients for us. What's in the pot?
Sure. First, and most importantly, you have interest rates. We are approaching a cycle of rate cuts. Gold loves low rates. You have to remember, gold is a rock.
Right.
It doesn't pay you a dividend. It doesn't pay you interest.
So when savings accounts pay 5%, holding a rock feels expensive. That's opportunity cost.
Exactly. But when rates get cut and savings accounts start paying 3% or 2%, suddenly that rock looks a lot more attractive. So ingredient one is the Fed cutting rates.
Ingredient two.
Geopolitical instability. Unfortunately, the world is a messy place, and gold is the ultimate fear trade. When tanks roll or missiles fly, money flees to safety.
And I saw in the data from, I think, February 9th, a reference to a rout in the U.S. dollar.
That's the third ingredient. The dollar has been weakening. And since gold is globally priced in dollars, it works like a seesaw.
When the dollar gets a cold, gold catches a fever.
In a good way, yes. It takes more dollars to buy the same amount of gold. So you have rate cuts, geopolitical fear, and a weaker dollar all converging.
There really is a perfect storm.
Yeah.
But I want to pivot to the vehicle itself. Why this specific ETF? There are plenty of ways to buy gold.
Sure.
You can buy coins, you can buy miners, you can buy cheaper ETFs.
Yeah.
Why does this specific trust get so much attention?
It comes down to the moat of the structure. This fund is the elephant in the room. It has the largest assets under management.
Does size really matter that much? I mean, if it tracks gold, right?
For you or me buying 10 shares, maybe not. But for the big players, for institutions, size is everything. It's about the liquidity premium.
Right.
Because this fund is so massive, it has the tightest bid-ask spreads.
Let's just define that. The bid-ask spread is the difference between what buyers are offering and what sellers are asking for.
Exactly. So if you're a pension fund and you need to move $100 million into gold this afternoon, you can't use a small ETF. You'd move the price too much.
You'd get killed on the spread.
You go to this fund because the liquidity is so deep you can get in and out without slippage. You're paying for the ability to be nimble.
And then there's the safety aspect.
Right. It's 100% backed by physical bullion. No debt, no leverage. It's structurally clean. I think of it as cash-like liquidity, but in gold form.
Okay, so we've got the whales buying, the banks projecting, massive upside, a perfect macro storm. I mean, it sounds like a no-brainer.
It does, doesn't it?
It sounds like we should all just mortgage the house and buy in. But, and there is always a but on this show.
Let's look at the flip side. Because nothing goes up in a straight line forever. And if you aren't looking at the bear case, you aren't investing, you're gambling.
Exactly. We need to talk about risks. This ETF has rallied 74% from its recent lows. 74%.
That's a massive move for a commodity. Huge. And when you have a move that vertical, the risk of a short-term pullback becomes very real. We call it mean reversion.
The rubber band.
Think of a rubber band. You stretch it, stretch it, stretch it. Eventually, it snaps back. The price has just sprinted so far ahead of its average.
And there was a specific data point on volume that caught my eye. Volume actually rose while prices were falling earlier in the week.
That is a classic technical warning sign. You want to see volume rising when prices are going up. That's conviction.
But when you see the price dropping and the volume is increasing?
That suggests conviction on the selling side. It's not just a few people taking profit. It could be the start of what we call distribution.
An early warning sign that volatility is kicking in.
Right. The easy money phase might be over.
Then there's the Fed failure scenario.
Yeah.
We talked about the perfect recipe relying on rate cuts. But what if inflation data gets sticky? What if the Fed looked at the numbers and says, actually, we aren't cutting rates yet?
That is the pin that could pop this entire balloon. The market has already priced in these rate cuts. If the Fed has to stay higher for longer to fight inflation, gold suddenly loses its shine.
Because of that opportunity cost.
Exactly. If I can get 5% risk-free in a government bond, why would I hold a gold rock that pays me 0? If rates stay high, that bond just looks a lot better.
And speaking of costs, let's talk fees. This SPDR Gold Trust is the biggest, but it's not the cheapest, is it?
No, not by a long shot. It has an expense ratio of 0.40%, 40 basis points.
Which doesn't sound like much, but in the ETF world, that's actually pretty high.
It is, especially when you have competitors, even from the same provider, like the mini version that charges a fraction of that.
I think it's something like 0.18%.
Something like that, yeah. And look, if you're a trader holding for 2 weeks, liquidity matters more than the fee. But if you're holding this for 10 years,
It adds up.
that 0.4% fee compounds your bleeding value. If gold just goes sideways for a year, you're losing money on fees alone.
That's a crucial distinction.
Yeah.
Okay, and finally on the risk side, volatility. This idea of when liquidity becomes volatility. Unpack that.
It happens in every big bull market. As the price gets higher, the swings get wider. A 1% move at $4,000 is a lot more cash than a 1% move at $1,000.
And that can trigger cascades.
Exactly. You have leverage traders piling in right now. If the price drops suddenly on some headline, they get margin called. They are forced to sell,
Which drives the price down further.
triggering more stop losses, and suddenly you get a flash crash. You can get these violent flushes. Even inside a bull market, the stairs go up, but the elevator goes down.
The stairs up, the elevator down.
Ah.
I like that. Okay, so bull case, bear case. Let's get practical. What are the key levels to watch?
The first one is psychological, that $500 level on the ETF.
The big 500.
It's a nice round number. Humans love round numbers. Watching if the ETF can cleanly break and hold above 500 is the immediate trigger.
And if it rejects hard, bounces off that like a ceiling.
That's a double top signal. That's bearish.
Okay, and if it does pull back, where are the safety nets? Looking at the chart, it's kind of a long way down.
It is. We need to look at the support zones. Based on volume analysis, there is a critical zone down around $298 to $310.
Whoa, hold on. 298 from nearly 500. That's a massive drop.
It is a deep level. It sounds scary, but remember, we had that blue sky breakout. The price went up so fast, it didn't build much structure underneath it.
It didn't build a foundation.
Exactly. So while we hope support kicks in much higher, structurally, that 298 to 310 zone is where the long-term value buyers are waiting.
Good to know. What about the calendar for the next 30 days? What events should we have circled?
3 main buckets. First, monetary policy. You have to watch every single communication from the Fed. Every speech, every release.
We're looking for hints of hawkishness. Anything that suggests they want to keep rates high.
Precisely. Any hints they are delaying cuts is a negative trigger for gold.
Which brings us to the second bucket, economic data.
Non-farm payrolls, inflation data. It's a bit perverse, but bad news for the economy is good news for gold right now.
Explain that logic.
Because weaker data implies the Fed must cut rates to save the economy, and rate cuts help gold. So a super strong jobs report. Expect gold to take a hit.
And finally, the wild card, geopolitics.
The factor we can't predict, any escalation in global tensions acts as a buffer for the price. It's the ultimate hedge against chaos.
Okay, so plenty to watch. Let's wrap this up with the lowdown.
Let's bring it all together.
We're looking at an asset at all-time highs, supported by what you call the central bank put, that price-insensitive buying, and we have a weakening dollar adding fuel to the fire.
That's the engine driving this whole thing.
But there is this tension. Long-term targets suggest another 20 to 30% upside, potentially $6,000 gold. But the short-term chart is screening overextended.
It's a classic battle between long-term value and short-term gravity.
So here's the question I want to leave everyone with. It connects back to that whale activity we started with.
It's a question about the money in your pocket.
Go for it.
If the central banks of the world, the entities that control the money supply, are buying gold at record rates to de-dollarize, if they are trading their paper currency for hard assets, what does that tell you about the long-term safety of the cash in your wallet? If they don't trust the paper they print, should you?
That is a little unsettling, but a very necessary question to ask. And that's the lowdown for today.
And hey, if you found value in this breakdown, make sure you hit subscribe. We're doing this every week.
Thanks for listening, everyone. We'll see you on the next one.